Good afternoon and welcome to Hardman Talks. My name is Richard Angus from Hardman & Co. and I'm delighted to have with us today Nigel Hawkins, who is Hardman's Infrastructure and Renewables Specialist. Welcome, Nigel.
Yes, good afternoon to you.
Now, your expertise has been very much in focus recently, and you've just published a major piece of work on the renewable energy infrastructure space, which in fact is an update, I think, on what you wrote a year ago. So why don't you tell us a little bit about this report and the significance of the differing power generation sources within the industry?
There's been a very big shift in recent years away from fossil fuel to renewable energy, and this has been reflected in the stock market, and particularly by the emergence of 17 renewable energy infrastructure funds, and their value now is the order of £10.5 billion to £11 billion. And most of them are pretty new entrants to the market, as investment in the UK goes heavily into onshore wind, into solar, and so forth. And it's very much a new sector. And compared with some of the other sectors, which have really struggled during COVID-19, I'm thinking, for example, of leisure, to name one, there's no doubt renewable energy, with its solid, secure earnings, and one has to say too, government subsidies, has been a pretty strong performer.
Is investment in renewables, in renewable power, is it really a growth industry?
Certainly, renewable energy is very likely to grow over the next few years. I think not so much on onshore wind in the UK, but certainly across Europe. And it's going to be offshore wind, the new go-to area for renewable investment. It's going to see a massive increase over the next decade. And solar also has taken off in the UK and is very popular in Spain, Italy, Portugal, and so forth. And I think looking forward, we're now seeing the coal industry and coal-fired power stations being closed down. Gas is really struggling unless it operates on a full-time basis, so that more and more energy is being produced from renewables, and that's going to create far more investment opportunities.
So if we look at the quoted renewable energy businesses, which types of renewable power are really making progress at the moment?
Well, if you exclude nuclear power, there are probably 7 main areas of renewable power. And the 2 most important by some way are wind and solar. Wind has been the one for some time. It's very strong onshore throughout parts of Europe. And offshore is going to be the big area for investment over the next decade. Solar has really come to the fore recently, particularly in southern England. And some of the Iberian countries, such as Spain, Portugal, are also heavy investors. So going forward over the next 10, 15 years, I expect onshore wind, particularly offshore wind, and solar to be major players. By contrast, marine, where there have been a lot of hopes, wave power, also a lot of hopes, they really have struggled to deliver any sort of viable returns.
So how has the sector and how have the funds coped with COVID-19? It's a very topical question. Things are obviously in a state of flux at the moment. What's your opinion on that, and how do you think things are going to pan out over the next year or two?
Well, there's no doubt the renewable energy infrastructure funds have been pretty reliable performers. Yes, their share prices fell quite strongly during March 2020. That's true of many stocks, as COVID-19 really bit into stock exchange valuations. Subsequently, most have recovered to their prices prior to March 2020, and they're seen as very defensive. If you compare that with Britain's leading gas player, Centrica, which recently cut its dividend by 58%, and if you compare it also with 1 or 2 other sectors, such as leisure, hotels, aviation, you'll see that, boring though 1 or 2 of them may be, there's no doubt renewable energy companies have done extremely well.
So to what extent are these companies dependent on public subsidies, and how has the pattern of public subsidies changed over the time, and how do you think it's going to evolve in the future? Because this clearly impacts investors' perception of the sector.
Yes, that's a very fair point. There's no doubt that up until 2017, subsidies have been crucial. The government in the UK now has stopped subsidising new wind and solar plants. So they have to be built without subsidy, which is happening to a certain extent in some cases. And for older plants, subsidies stay in place, but there's no doubt that the revenues are quite dependent upon subsidies. And it's going to come a fair challenge, I think, particularly for the solar companies going forward. Can you make money out of solar plants without any subsidies whatsoever? And the answer is yes, you can if you can get operating costs down. And that's, I think, is a challenge for them.
Okay, so many of these companies that you know have been able to pay good dividends and avoid cuts, but do you think this is going to be something that's going to continue? So maybe you should start by giving us an idea of what sort of dividends these companies currently pay, what the history of their dividend payments has been, and then how do you think this is going to play out going forward?
Well, some of the more mature renewable energy infrastructure funds are on a dividend yield of close to 6%. And in most cases, there's been a slight increase in recent years on their dividends. And you should compare that with some of the big energy companies where big cuts are taking place. And of course, elsewhere in the market, where we saw, particularly in March, April 2020, a number of household names either suspending their dividends or indeed cutting quite savagely. Of course, Shell's 66% cut in their dividend, the first since World War II, stands alone in terms of a dividend cut probably. But for these renewable energy infrastructure funds, they're still paying dividend increases in most cases. Yes, some have held their dividend recently, such as Trig, one of the larger ones, the 17. But on the whole, the dividend payments are seen as pretty solid and pretty secure.
We're talking about a global industry here. So how many of the 17 quoted renewable companies that you have in your report, or funds you have in your report, are operating in foreign markets? And can you just say a little bit more about what sort of activity they have and their plans for expansion?
There's a fair amount of variation. Greencoat UK Wind, amongst the most valuable of the 17 that operates exclusively in the UK. Trig was very dependent on the UK, but recently has expanded heavily into continental Europe, particularly into Sweden, into France, into Germany. And we have seen one or two new arrivals who are based in the US, for example, and particularly investing in US solar. So I think the trend now is if you can invest in the UK, fair enough. But a number of them are really expanding into Europe. And there's a bit of a land grab in some cases for sites, for solar, in particular in Southern Europe and for wind in Northern Europe, amongst the various companies, and indeed a few others will probably come to market over the next 2 years as well, in order to secure the sites to generate the returns they hope they can.
Now, Nigel, there have been a number of fundraisers in this sector recently. Do you think you could just remind us what they are, and do you think they will be continuing over the next 12 months?
Yes, it's certainly the case that many of the funds in the sector have raised money, mainly to invest in new renewable facilities, whether it's solar or indeed wind. I think these fundraisers will continue. I think the important thing for investors is that in most cases, these fundraisers have been both oversubscribed and undertaken at a relatively small discount to the pre-existing price, which certainly for anybody trying to raise money on their behalf is good news.
Just to play the devil's advocate here, because obviously this is a very, I would say, a very warm sector, but what are the major risks for investors entering the sector now for the first time?
I think there are a number of risks. Clearly, one is the impact of lower power prices, which does bring down the valuation of some of these funds and has been responsible for the slight reduction in share prices we have seen. Secondly, regulatory risk is always there. Governments can reduce the subsidies that they're prepared to pay, and that could have adverse effects on their share price rating. But I would suggest that the risks are actually quite modest, particularly in terms of revenues, compared with many other risks applied to other sectors.
When you're writing this report in a year's time, 2022, what do you think are going to be the major changes that will be incorporated?
I think, first of all, there'll be rather more funds I'll be writing about than the 17 on this occasion. I expect quite a number of new funds to come to the market. Secondly, I hope, and I'm sure everyone hopes, there'll be far less emphasis on COVID-19, its adverse impact, and far more on the fact that renewable energy is set to grow quite strongly, particularly, I think, in mainland Europe, Germany being a case in point where a massive amount of new power is needed to replace what's going to be lost when all the nuclear power stations are closed. So I think that will be a key message. And if you compare where the sector was a few years ago, where frankly it was barely known and a few funds were there and nothing more, I think it's going to be a very significant story in energy over the next few years.
Well, Well, Nigel, it's been absolutely delightful having a chat with you this afternoon. Your report is obviously on the Hardman & Co website for anybody to access. Thank you very much for your time, and thank you very much for watching.
My pleasure.